Did you know there's a small-cap AI stock that just had its best trading week in 9 months, while the rest of the market was getting beaten up by geopolitical tensions and rate anxiety? And what if I told you that underneath the surface of this quiet little breakout, there's a secret pressure building, one that most retail traders don't even know how to read, that could send this stock to a completely different level? Welcome back to Smart Stock SAM, where we cut through the noise and give you the kind of clear, data-driven analysis that actually matters for your portfolio decisions. Today, we're going deep on SoundHound AI, ticker SOUN. And trust me, by the end of this video, you're going to look at this stock in a completely different way. We're talking about a billion-dollar acquisition that almost nobody is pricing correctly, a retail partnership that's already live across thousands of stores, a valuation trap hiding in plain sight, and a short interest setup so loaded that one wrong move from the bears could trigger an absolute fireworks show in the coming days. That's the secret, and we're about to break it all down. Here's exactly how we're going to do this. We'll start with where the stock stands right now, then dig into what's driving the momentum, the real merger math behind the LivePerson deal, live enterprise proof from Casey's General Stores, what Wall Street and retail traders are saying, and why they completely disagree. Then we get into the technical setup, the options battlefield, analyst targets, and finally, a clean trade blueprint with entries, targets, and stops. And yes, we'll tell you exactly what date to circle on your calendar right now. Let's get into it. Right now, SoundHound is trading at $8.19 off a 4.73% single-day gain. But zoom out just 30 days, and the picture gets even more interesting. The stock is up 39% in that window. 39% while most of the market was treading water. Now, a lot of momentum chasers see that green candle and they just jump in. But that's not how we do things here on Smart Stock SAM. We ask the harder question, where is this actually going? And does the story hold up? Management has put a number on the table. A $500 million revenue opportunity. That's the mountain they're climbing. And while that growth narrative sounds exciting, there is a specific valuation trap buried in the fundamentals that we need to address head-on. And we will. But first, let's understand what actually lit the fuse on this 39% move, because it was not just hype. This breakout has a structural foundation, and I call it the dual catalyst growth architecture. Two engines are firing simultaneously. Engine 1 is the LivePerson acquisition, SoundHound's aggressive move to own the full omnichannel customer interaction stack. That means they want to be the intelligence behind both your voice assistant and your chat window. That's a very different kind of company than they were 18 months ago. Engine 2 is enterprise scale, the Casey's General Stores expansion, which we'll cover in detail in just a moment. This is real-world, live, at-scale deployment, not a press release. The combination of strategic M&A and organic contract wins is what has institutional eyes turning back toward SOUN. That said, and I want to be honest with you here, merging two companies is like performing surgery while running a marathon. There's a lot that can go wrong, and we're going to look at exactly what those risks are. But let's start with the merger math, because the numbers tell a really interesting story. SoundHound acquired LivePerson for an equity value of $43 million. On paper, that looks like an absolute steal for a company processing 1 billion monthly messages. When you factor in the debt restructuring, the total enterprise value comes in around $250 million. Still a compelling price for that kind of messaging infrastructure. Here's why this deal matters. By layering LivePerson's digital text platform on top of SoundHound's proprietary voice AI, they've now raised their 2027 revenue guidance to between $350 and $400 million. And the deal instantly gives them access to 25 Fortune 100 companies, relationships that would have taken years to build organically. But, and this is important, LivePerson was a company in trouble. They were struggling for a reason. SoundHound has absorbed that baggage, along with the balance sheet complexity that comes with it. If the integration stumbles, that guided range starts to look a lot less achievable. Keep that in the back of your mind as we go forward. Now, for all the future potential in that acquisition, The partnership I'm about to show you is about proof right now. Want to know if SoundHound's AI technology actually works? Don't listen to the press releases. Look at Casey's General Stores, 2,600 active locations, fully deployed, running SoundHound's AI agents in production today. This is not a pilot. This is not a beta test. This is full-scale operational deployment. And the output? These AI agents have already handled over 21 million successful customer interactions, 21 million data points that SoundHound is using to train and refine its models faster than almost any competitor in the retail and hospitality space. This is what institutional investors mean when they talk about enterprise validation. It's the proof of concept that separates a real product from a demo reel. SoundHound has it. And now, here's where things get really interesting, because despite this operational proof, the market is completely divided on what to do with this stock. Welcome to what I call the sentiment bifurcation, and it is stark. On one side, retail traders and momentum players are extremely bullish. They see SOUN as a generational AI opportunity that could multiply from here. On the other side, the Wall Street establishment is far more cautious. Most notably, Jim Cramer recently gave a blunt public warning. His position was clear: stay away, citing the total absence of current profitability. Here's the truth: both sides have a valid point. The retail bulls are right that the growth trajectory is real. The institutional skeptics are right that growing revenue while losing money on every dollar is a dangerous tightrope to walk. When these two forces collide at this scale, there's only one guaranteed outcome, and that's volatility, which brings us to the actual money moves happening behind the scenes. Here's where the data gets genuinely cloudy, and I think this is the most important section of this entire video. On the institutional side, Rakuten Securities increased their SOUN stake by a staggering 877% in Q4. That is not a small tweak. That's a conviction bet. But now, look at the insiders, the people actually running SoundHound. In the last 90 days, the CEO, CFO, and COO collectively sold over $2 million worth of shares. And then the CFO, Nitesh Sharan, announced he's leaving the company to join a quantum computing firm, right after a major acquisition. I want to ask you something. When the person in charge of the checkbook walks out the door right after the most complex financial move in company history, does that make you more confident or less? Drop your answer in the comments. I genuinely want to hear your take on this one. Are they selling because the valuation is stretched? Do they know something we don't? This ambiguity is part of why the stock behaves the way it does. And to really stress test this, let's go to the raw fundamentals. Revenue growth is explosive, nearly 60% year over year. That's top tier, no question. But here's the valuation trap I promised you. SOUN has a negative net margin of 8.7% and a projected EPS of negative 34 cents. They are losing money on every dollar of growth. And then there's the price-to-sales ratio, the number that stops me cold every time I look at it. SOUN is trading at 20.7 times sales. The industry average? 3.7 times. You are paying a 500% premium over comparable software companies. For that premium to be justified, the LivePerson integration has to be flawless. The 2027 guidance has to be credible. And execution has to be tight. If any of those assumptions crack, fundamental gravity will do what it always does. Now, here's the thing. The technicals don't care about any of that right now. And if you're a shorter-term trader, the chart is sending a very different signal entirely. Forget the price-to-sales ratio for a moment. If you're reading price action, the chart is flashing strong buy across almost every metric. SoundHound is trading above its 5-day, 10-day, and 50-day moving averages. That's a clean, bullish alignment. The RSI sits at 57, the sweet spot. Enough momentum to keep running, not overbought enough to trigger a reversal. And we just saw a bullish MACD crossover, a classic momentum confirmation signal. The only ceiling left on the chart? The 200-day moving average at approximately $10.90. If SOUN breaks and holds above that level, we are looking at an entirely different ballgame. But here's what makes this setup even more explosive. There's a hidden force building beneath these charts, one that has nothing to do with earnings or acquisitions, and it could compress the entire timeline dramatically. I want you to pay close attention to this one. 38% of the float is currently sold short. That is a massive short position. But here's the number that's actually alarming the bears right now. The borrow fee rate just surged to 23.01%. At the start of the month, it was 8%. It has nearly tripled in weeks. It is becoming dangerously expensive for short sellers to hold their positions. With days to cover as high as 7.4, if SOUN pushes past a critical price trigger, those short sellers cannot wait. They get forced to buy back their shares all at once. That buying creates more buying, which forces more covering, and you get the feedback loop known as a short squeeze. The pressure is absolutely there. The question, and this is the one that keeps traders up at night, is exactly where the breaking point is. To answer that, we go to the options market. The options chain is essentially a map of where the money is positioned. For the May 1st expiration, the picture is clear. There's a massive wall of call options at the $9 strike. That's the immediate ceiling. If price touches $9, market makers will likely be forced to hedge their positions by buying shares, which could push the price even higher in a self-fulfilling move. On the floor, strong put protection at $8, meaning there are a lot of traders betting the stock won't easily fall through that level. So we're boxed between $8 and $9. Whichever wall breaks first sets the directional trend for the next month. That's your range. That's your battlefield. And where do the professionals think this is ultimately headed? The analyst community is surprisingly unified on the upside. The consensus price target is $14.93. That's a substantial return from where we're sitting today. Leading the bulls is H.C. Wainwright with a $20 price target. Even the more conservative voices like Piper Sandler are sitting at $9. When the entire analyst range sits above the current price, it signals that the market hasn't fully absorbed the growth impact of the recent acquisitions yet. Worth noting, these are 12-month targets, not next Tuesday's price. But the directional conviction from Wall Street's own research desks is clearly to the upside. Now, how do you actually trade or invest in this? That depends entirely on what kind of player you are. Before you touch this stock, ask yourself one question: am I a trader or an investor? The short-term trade is purely mechanical. You're playing the borrow fee pressure, the short squeeze trigger, and the May 7th earnings volatility window. You're not betting on the company's future, you're betting on price action and mechanics over the next few weeks. The long-term investment is a fundamentals bet. You're saying you believe the LivePerson integration will succeed, that cross-selling into the Fortune 100 is achievable, and that by 2027 they hit somewhere near that $350 million guidance. If they do, current prices look like a historic discount in retrospect. If they don't, the downside is real and it is significant. Both approaches are valid, but they require completely different risk tolerances and time horizons. Now, let's get specific. Here are your numbers, clean and simple. Tactical entry is right around $8.19 where we are now. If you want confirmation before committing, wait for a breakout above $8.93. That tells you the $9 wall has broken and momentum has shifted. Immediate resistance is $8.50, but the real target zone is $8.80 to $9. On the downside, and this is non-negotiable, your near-term support is $7.81. For an active short-term trade, your stop loss is firm at $7.50. If it hits that level, the squeeze thesis is dead for now. Walk away and reevaluate. For the long-term holders, your ultimate floor to watch is $5.95. Stick to these levels. Discipline is what separates traders who survive from those who don't. Let's bring this home. The opportunity is real. SoundHound is consolidating the voice and digital AI market simultaneously, building a moat that even big tech would find hard to replicate overnight. The Casey's validation, the Fortune 100 access from LivePerson, and the short squeeze pressure, these are legitimate catalysts. But the risk is equally real. A debt-heavy acquisition, insider selling, a CFO departure, and a valuation that prices in everything going right. This stock does not forgive sloppy execution. Circle May 7th on your calendar right now. That Q1 earnings report is the make or break event. It will either confirm the LivePerson integration thesis or expose the cracks. Either way, we are guaranteed to see major volatility, and being positioned before that event with clear levels and a solid plan is how you win. My read: the technicals and squeeze mechanics suggest short-term fuel remains in the tank. The long-term story lives or dies in the first 90 days of the LivePerson merger. Watch those support levels. Stay disciplined. Now, before we wrap up, I have an obligation to be straight with you. Everything discussed on this channel, including price targets, trade levels, and all strategic analysis, is strictly for educational and informational purposes only. Nothing here constitutes financial advice, investment recommendations, or a solicitation to buy or sell any security. Always do your own research and consult with a licensed financial professional before making any investment decisions. Investing in individual stocks involves significant risk, including the potential loss of your entire principal. We are here to educate, never to tell you what to do with your money. Now, before you go, I want to hear from you. Here is my question for the comments today. With the CFO leaving right after the LivePerson deal closed, is that a genuine red flag that changes your entire thesis on SOUN? Or is it just noise you're willing to look past for the upside potential? Drop your honest take below. The most thoughtful answer gets pinned at the top. If this breakdown gave you real clarity on a stock you've been watching, go ahead and hit that like button. It takes 1 second, and it genuinely helps this channel reach more investors who need this kind of analysis. And if you're not subscribed yet, what are you waiting for? Hit subscribe and ring the bell so you never miss a breakdown like this one. And if Smart Stock Sam has ever helped you catch a move early, avoid a bad trade, or just given you more confidence in your decisions, consider sending a super thanks using YouTube's support feature right below this video. Every single one goes directly back into making this content sharper, faster, and more valuable for you. Stay sharp, stay disciplined, and I'll see you in the next one.